that the argument that the banking system has used in general is that why would I want to give you entrepreneurial capital a 15 or a 20 or a 25% return when I can hold the problem and generate that capital return for myself? So what you've seen is a market that's stalled out. But there's one big difference from the early 90s that I'd pay significant attention to that's really devoid of real estate and real estate capital. It's in part the question of how did we get out of the 90s? What's the difference to today? The difference is there was uncorrelated capital in the 1990s, and a bunch of smart guys figured out this thing called securitization. And securitization brought money in from the fixed income part of the world that had previously not existed before. So you had a source of takeout capital for all the capital that had been impaired previously. The RTC did what was known as the N-series securitizations. Fixed income investors bought in, hedge funds bought in, and that was at least the capital solution to bailing out. Today, you don't have uncorrelated capital. If you saw CNBC a few months back, they interviewed a woman in Norway who was the mayor of a little quaint town of about 2,000 people, and she was the mayor and the treasurer and the custodian and the whole shenanigans. And they said, tell us about your financial position. She said, we're going broke. Norway, 2,000 people. Why are you going broke? Because we own CDOs and CMBS. The point being that the markets got so efficient, capital was able to flow from Wall Street to small towns in Norway, right? Where are you going to find replacement capital for the capital that is already currently over its ski tips or troubled? I think that's one of the challenges.
Give it 2 years. David.
Give it 2 years. Memories are short. I think that's valid. But think about having uncorrelated capital in the early 90s and everybody being in the same boat today makes a big difference. I think what you're seeing, and really to Larry's point, the financial institutions are beginning to write things down. They're recapitalizing themselves with their internal earnings from their underlying businesses. Last time I checked my checking and money market account, I was receiving, 0% interest, right? And so that 0% interest was then in turn being reinvested in portfolios in the banks at 5% or 6% or 7%. And you think about 500 or 600 basis point margins, that's fantastic. So what's the answer to the question? The answer to the question is the banks are recapitalizing themselves. The loans in their portfolios are really kind of old inventory in a retail kind of analogy. So we're beginning to see the banks offer discounted payoffs to their borrowers, sell their underlying notes, and really begin to move properties out at a market basis. That's setting pricing. That will accelerate what we think will be trading. So we're seeing a lot of business in the area of purely helping guys refinance out of the banks. How do they do it? They go to Joel or they go to Bill, and Bill or Joel says, I can get you 60% first mortgage loan, and then they need another 20%, which could be a mezzanine or preferred equity investment, and suddenly they have enough capital to leg out of the bank into a fresh capital structure. We're seeing that beginning to leak into the market, and our thesis is in 2010, I don't think you'll see a sea change in the market, but you'll see as the banks recapitalize, as the insurance companies recapitalize, much more transactional activity, which will be healthy for really everybody at this table.